Hi everyone, so welcome to the live stream today. My name is Nhyira Premium, and it's always a pleasure coming your way as we continue with our discussion for the ICA August 2022 examination, and want to continue with the IFRS masterclass, looking at the key fundamental financial reporting standards that we need to pay attention to if you are writing financial reporting in the ICAG level 2 or corporate reporting in the ICAG level 3. So look at those basic standards and explaining the principles, and most importantly, knowing how to learn these standards together to increase your chances of retaining the principles that relates to the standards, and also enable you to really answer questions that relates to the standards. So you are welcome to the live stream today. We want to continue with our discussion that we started with last week on the IFRS masterclass. I discussed the issues relating to IAS 2, inventories, IAS 8, accounting policies in accounting, estimates and errors. And then we also discussed the issue about IAS 10, that is the events after the reporting period. And we saw the summary principles relating to these standards. Today, we want to get into the main discussion of the accounting standards, starting our discussion with IAS 16. And I'm going to introduce you to IAS 37, provisions, contingent liabilities, and contingent assets. Then we also going to see probably along the line IAS 36, that is impairment of assets. So we have a lot to go through today, hopefully within the time we have at our disposal. And I see some of you guys joining. You are welcome. Give us a thumbs up on the video, it helps us a lot. And also share the video. Let us reach many students watching this video, and together let's assist a lot of students to prepare well for the examination, and most importantly, pass the exam. So if there are any questions for me, hit me up with these questions, and let me see if I can provide you with some answers real quick as we begin our discussion. Raymond Olumedi said, great. Okay, thank you for joining us. We also have Alan Simwanza said, thank you all. You're welcome. Alan said from Zambia, thank you for joining us from Zambia. Isa Lulu said, good evening, sir. Good evening, Isa. Thanks for joining us. Johnson Tete said, good evening, Shira. Good evening, Johnson. Thanks for joining us. Then he said, good evening again. Okay. So Alan said, please today touch on comprehensive treatment, especially to do with changes in estimates. I don't get the context, because we discussed the issues about treatment of changes in estimates in last week lecture. So maybe you can watch that on the portal. Sorry, you can watch that on the YouTube channel. Just last week, as a Wednesday or so, we discussed that, and we discussed the issue about changes in accounting estimates. So I suggest that you watch that video to see the explanation of those standards. Does that make sense? Any other questions for me, hit me up and let me bring up my screen. And remember, you can download the Nhyira Premium mobile application on the Google Play Store or the App Store. It gives you access to exclusive lecture videos that are not available here on YouTube. You get access to also some notes, blog posts as well, and you get access to those various contents that will enable you to be able to pass the examination. So download the mobile application if you have not, and you will be able to get access to these exclusive contents, and also get access to the various things that you need to know about the notes and blogs that you need to have an idea of to enable you to pass the examination. So let me know any questions for me, hit me up. We're going to look at the IFRS masterclass today. I'm introducing you to IAS 16, property, plants and equipment. Then we're going to be also going into IAS 37 possibly as we go along, because I want to really let you understand, and then IAS 23, the way the standards are interconnected and the way they are interrelated. And that is exactly what I'm going to be trying to do on the stream today, to enable you to really understand how the accounting standards are interrelated. Please note that my discussions for this whole masterclass will be coming in from my book on financial reporting, and we also have corporate reporting. It's in volume 1 and volume 2. So all my discussions will be coming in from these books. Corporate reporting also here for volume 1 and volume 2. These are all notebooks that we released in about a little over a month ago, so 2022. And so all my discussions, questions we'll be solving and everything are primarily going to be coming in from the from this books or one of these books in our discussion. See, I see some charts coming in. Let's take it and then let's begin the discussion for today. Master, I am from WA. How much is the cost of management accounting? Our management accounting lecture is 390 Ghana cedis per paper. Actually, our lectures are 390 Ghana cedis per paper across all levels. And you can visit our website, nyhirapremium.com. Make sure you read the terms and condition page before enrolling in a course. That's very crucial for us. So it's 390 Ghana cedis if you ask. Raymond said, Nhyira, thank you for your labor of sacrifice. I do enjoy your videos. God bless you. God bless you too, Raymond. And thanks for sticking with us. Annie Mary said, good evening, sir. Good evening, Annie. Malinga said, good evening. I'm watching from Namibia. Your videos are very resourceful, sir. Thank you very much. And shout outs to you there. Thank you really, really very much. Abel said, good evening. Good evening, Abel. Thanks for joining us on the live stream today. Alan said, do you subtract impairment loss from, let's say, goodwill, then write the loss off to P&L and put the remaining amount of goodwill as carrying value on BS? I don't understand the context of your question. I don't understand the context of your question. Now, in accordance with IAS 36, when there is impairment, are you talking about impairment in goodwill or impairment in a cash generating unit? Because the treatments are different. If we are dealing with consolidated financial statements and we are dealing with impairment in goodwill, then what is going to happen is that the impairment in goodwill is an expenses. So definitely, if you are preparing the consolidated statement of profit or loss, then it will be written off as part of cost of sales or as part of administrative expenses in the consolidated statement of profit or loss. If you are preparing the consolidated statement of financial position, then probably it will be treated as a deduction from the group retained earnings. But that will be based on whether NCI, that is the non-controlling interest, is valued at fair value or valued at the cost module or the alternative method in that case. So if you're talking about impairment in goodwill, then that is how you go. Then in that case, you subtract the amount from goodwill, and then the carrying amount will be what goes to the statement of financial position. So probably give me some context, then I can provide you with a better understanding in that regard. But then if you're dealing with goodwill impairment in cash generating unit, which is a whole business, a group of assets, then the treatment of goodwill as per IAS 39, IAS 36 will be given by a certain rule where we write off goodwill first. Then if there is any amount left, we write off any, no, we will write off separately identified impaired asset first. Then if there is any goodwill, we write it off. And I'm going to go through that with you later on. So I don't know the context in which you are asking your question, but when it comes to impairment treatment, these are the two schools of thought or the broad understanding that we can come in from. Jojo Poku said, what is the cost of public sector accounting class? 390 Ghana cedis per paper. All our subjects, 390 Ghana cedis per paper. So you can visit our website. You can check the description of this video, NhyiraPremium.com, and enroll in a course, or you can WhatsApp us. You see the number scrolling below your screen. You can WhatsApp us 05011499296 and be given guidelines on it. Eric Ahiadeki said, good evening, boss. Please, I need your contact. Okay. Yeah, my number, our number is scrolling below the screen, 05011499296. 05011499296. You can see it below the screen there. So you can WhatsApp us there. Vida said, hi, Nhyira. Hello, Vida. I hope you're doing well. Joshua Boachi Adam said, Nhyira, please, when are you going to give us advanced audit lectures? Ooh, that's nice. We've not had topics relating to advanced audits. Like, I don't know, but we've not really had topics relating to advanced audits. Have we had anything? No. the questions we posed, the topics we've received. the, okay, I have one thing here: audit evidence and audit reporting. So what we are doing, it's based on the interest that we have available. So if there is something in advanced audit that you would want me to share my thought on, then you can put it in the chat, because what I have here is just one item, that is audit evidence and reporting. And we're going to be putting these topics together and taking a stream about it based on the number of interest we get generally. Okay, so if it is something you are interested in, you may want to put the topic in the chat, and then we can add it to our list here and see how we can look at that. Eric said, can non-performing loans be impaired? Thanks. Yeah, definitely. If a loan is non-performing, that means you have to write it down. All right. So we have customers who owe us a lot of money, and they are not able to pay us, probably due to the economy or whatever the heck it is. Its impairment must be written off. And if it's there for a long period of time, even the Bank of Ghana or the regulator may require that those non-performing loans be written off from the books of the entity, because that may be misleading. If you give somebody loan and you didn't do your credit score or credit worthiness well, and the person is not able to pay you, or the person is now bankrupt, then what the heck? You just have to write it off at the end of the day. So non-performing loans can be impaired, and they must be written off in the P&L account. Johnson said, Nhyira, please, level one accounting, what's some of the most areas that they usually set questions on? Everything in the syllabus is examinable in the exam hall. So there is nothing like key areas. Number one, there will be financial statement preparation for companies, sole proprietorship, or partnership. These three things, two of them will be in the exam hall. Final accounts for companies, sole proprietorship, partnership. These three things, two of them will be in the exam hall. Then the examiner may bring questions relating to the fundamental issues about ratios, a little bit introduction to ratios there, then issues relating to the day books, the control accounts, sales ledger control accounts, purchases ledger control accounts, then partnership, dealing with partnership as a topic. That is also something that you need to know about and understand. Then certainly some theories in relation to the uses of financial statement, differences between financial accounting and then management accounting, then also the general conceptual framework for financial reporting. All these are areas that the examiner, it's likely going to be setting questions on. So any critical area or section of the financial accounting syllabus, there will definitely be a question coming in from there that you have to know about. So Johnson, if you ask that, that is what you need to know about. Ndoro Melodious said, hey Nhyira, hi Melodious, I hope you're doing well. Vida said, please, I want to know the lecture schedule for public sector accounting. Our main lecture, public sector accounting, is Mondays, like today, 6 p.m. to 9 p.m. You can send hi on WhatsApp. Our timetable will be sent to you and you can look at it. But public sector accounting is on Mondays, 6 p.m. to 9 p.m. In that case, I think today we even have performance evaluation test, and I can't wait for that performance evaluation test in a few minutes. Emmanuel Dazi said, thanks for your good works, always a pleasure, and thanks guys for your continuous support in that regard. Okay, so let's get excited about it. Let me bring up my screen and then let's get into our discussion for the day. If there are any questions, don't hesitate to put it in the chat for me. I will be excited to take all your questions as we continue with the discussion for the day. So let me bring up my screen. There you go. And we want to look at IAS 16, property, plant, and equipment, the OG of all the standards. That is where everything starts from. So IAS 16, property, plant, and equipment. If you remember last week, in the section 1, we started our discussion off to say that when it comes to dealing with non-current assets, there are a number of accounting standards that we need to be mindful of, like IAS 16, IAS 20, IAS 23, IAS 40, and IFRS 5. So these are non-current asset standards that we need to be mindful of. Then I said, when you are dealing with the issue about IAS 16, you have to be mindful of IAS 37, because at the initial recognition, IAS 37 plays a key role in that regard, and you're going to see that here in a moment. Then I said, if you pick any accounting standard at all other things being equal, you have to know about the objective of the standard, the key definitions that you have to be aware of, the recognition criteria for the item in the question, the initial measurement or initial recognition, and most importantly, subsequent measurement and disclosure requirements. And I mentioned that the examiner can throw you questions from the initial recognition down to the disclosure requirements. And so when you pick any standard at all, you need to be mindful of what is the recognition criteria, if it has one, what is the initial recognition or measurement, what is the subsequent measurement, and also what disclosures in the footnotes are required relating to that particular standard. So it is important for you to understand these key things when you pick any standard at all. But let's get excited about the day's discussion, and that is IAS 16. Now, you see, usually the way an entity on the average accounts for non-current assets depends on the usage of the non-current assets in question. Okay, depends on the usage of the non-current assets in question. So let me bring up my slide and show you exactly what I'm talking about. So when it comes to the tangible non-current assets, you have to understand what is going on generally about that. So, for instance, all the non current assets can broadly be divided into two. We have the owner occupied non current assets. Okay, owner occupied. When we say owner occupied, it means that the asset is being used by the entity that controls it, either for administrative purposes, as a warehouse, as a showroom, or as a car park. Okay, they use the assets in the day to day running of the organization. So that becomes an owner occupied asset. For those assets, they are accounted for in accordance with IAS 16, that is property, plants, and equipment. IAS 16, property, plants, and equipment. However, there are other assets that a company controls. Now, remember, the key word here is not that, oh, the company owns the assets. The key word here is that the entity controls the assets. We established this in the section 1. So there are certain assets that an entity controls, that is recognized as part of the asset of the entity, but then they are not occupying those assets. For instance, they are held for rental purposes, or they are held that is under operating lease, or they are held for capital appreciation purposes, or the entity is just undecided on what it will use the assets for. Example, there is a land that the entity has bought, and the entity is undecided as to whether to build a new headquarters or a new factory, or what to do or use the land for. In such circumstances, what is going to be happening is that the entity then would have to account for such assets in accordance with IAS 40, and that is investment property. Does that make sense? So the way we account for the assets that an entity controls, the assets in the books of an entity, would depend on whether it is an owner occupied asset, tangible asset, IAS 16, or a non-owner occupied tangible asset. And that is in order or in accordance with IAS 40, investment property. Our discussion today is going to be centering around the IAS 16, property, plants, and equipment. So to get excited about it, let's look at some few definitions that we need to familiarize ourselves with, and in order for us to build our knowledge up generally in that particular case. So when we say property, plant, and equipment, in a simple language, we are just talking about the tangible assets with the following properties. That is, one, held by an entity for use in the production or supply of goods or services, okay, or for administrative purposes. or expected to be used during more than one period. So that is property, plant, and equipment generally. Generally. But as we get ahead and learn more in financial reporting and corporate reporting, there are certain key terminologies that we need to really familiarize ourselves with and really have at our fingertips. The first one is, what do we mean by the cost? So when we say the cost of an asset, what is that? When we say the residual value of an asset, what is that? When we say the fair value of an asset, what is that? When we say the carrying amount of an asset, what exactly is that? So, in a simple language, when we say the cost of an asset, it is simply the amount of cash or cash equivalent paid or the fair value of other consideration given to an asset at the time of its acquisition or construction. Okay, the amount of cash paid. So, for instance, let's say we go and buy a new office building. Okay, we go and buy a new office building for whatever, let's say $1 million. That becomes the cost of the office building, $1 million. There are other times we don't have to pay $1 million. Maybe we will exchange an asset. So it will be an exchange transaction in the sense that probably we have a land and we exchange that with another company that has an office building. Okay, and we exchange that as an office building. So what is going to be happening is that maybe the fair value of the building is going to be determined, maybe $10 million. The fair value of our land is going to also be determined. So what is going to be happening is that the value of the land of the exchange is what to be seen as what the cost of the building in that particular case. So that is the first thing we must understand. Cost. It is the amount of cash or cash equivalent paid or the fair value of other consideration given. Other consideration given is through usually exchange of assets. When we say the residual value of the asset, it simply means, another name for that is the scrap value. Residual value is the same as the scrap value, is the same as the terminal value. It is simply the value at which an asset will be disposed of at the end of its economic useful life. Now, the economic useful life of an asset is simply the estimated number of productive hours or productive period that the asset is expected to be used. Okay, the estimated number of years or productive period that the asset is expected to be used. So, for instance, if we bought a plant and equipment, and we say that, okay, this plant and equipment, we're going to use it for 5 years, that becomes the economic useful life. Now, when we use it for 5 years, we are going to sell it for whatever. Let's say we bought it for $2 million. We can sell it for $50,000 after 5 years. That means that $50,000 becomes the scrap value, becomes the terminal value, becomes the residual value, the value at which an asset is sold at the end of its economic useful life. The value at which an asset is sold at the end of its economic useful life. Then we look at fair value. This is one of the fundamental things you need to understand as a student studying financial reporting and corporate reporting. When we say fair value in a simple language, it is simply the value at which an asset can be exchanged or liability settled. The value at which an asset can be exchanged or liability settled. That is the fair value. So it is the price that will be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. That is the fair value of an asset or fair value of a liability. So how much will we get if we exchange this asset? That is the fair value of the asset. Now you have to be careful because it is not always that the fair value will be the same as the market value. Sometimes there will be difference between that at the end of the day due to related party transaction, because the fair value is assuming or the selling price. Let me put it this way: fair value and the selling price. There may be distinction between this. Fair value and the selling price may not always be the same, because the fair value is assuming we are selling to an independent party, or the transaction is occurring between independent market participants, what will be the amount that they will sell it at? That will be fair value. The selling price is actually the price that the thing is sold at. So let me give you an example. Let's say that I want to, I have a company. So let's say MP Limited. Then there is another company. Let's say whatever, YF Limited. Okay. YF for YFE Limited. So let's say I have another company called YF for YFE Limited. So this is what's happening. This is what's happening. So let's say that there's another company here called JQ Limited. What would that be? I don't know. So this is what's happening. Let's say that NP Limited is a consultancy firm, and for consultancy firm, when we render a certain service, maybe business advisory services in terms of product development and market introduction of products and all that, let's say we charge whatever, let's say $10,000. So that is the fair value that we charge. That is the price that we charge. Let's say, for instance, my wife's company comes to us and then we sell that same service to them at $8,000. Then the JQ company, we still sell it to them at $10,000. Now, in a way, what is happening here is that I sold it to them at this price, which is not the same as the fair value of the service, which is 10,000. But these people, I sold it to them at the fair value of the service, which is the 10,000. So that is the difference. Sometimes selling price may be different from fair value due to related party situation. Okay, due to related party. Because if there is a related party, then the selling price may be less than the fair value or higher than the fair value. Now, for tax purposes, this is outside your scope though. But for tax purposes, when the GRA comes or the HMRC come, Royal Majesty Customs, Revenue and Customs in the United Kingdom, if they come, they will reverse the transaction because that amounts to transfer pricing, which is illegal. So they may reverse the transaction into its true nature. So even though the YF Limited bought it at 8,000, they will, once they establish that that's a related party transaction, they will still account for it as 10,000 and tax us on that. But that is the idea about fair value and selling price. Sometimes it may have differences, or there may be difference because of related party. Other times they are going to be the same. I hope that makes sense. Let me know if there are any questions coming up. Then the last thing is carrying amounts. Now you know those already from KG2. The carrying amount of an asset is simply, or the carrying value is simply the cost of the asset or the revalued amount of the asset minus accumulated depreciation or impairment loss. That's the carrying amount. That is the value at which an asset is carried on the face of the statement of financial position after depreciation and what? Impairment. So the carrying amount or carrying value of an asset is simply the value at which an asset is carried in the books of in the statement of financial position after depreciation and then impairment loss. So these are the key issues that we need to understand when it comes to some definitions about this standard. I hope that makes sense. Let me know if there are any questions about this, and then I'm going to take them for you in that regard. Then we move on to the next one, and that is, what are some of the issues in relation to property, plant, and equipment? When we say property, plant, and equipment, what are some of the things that we can say there? Okay, we can talk about vehicles, furniture, machinery, building, undeveloped land. All these fall into the category of property, plant, and equipment. So generally, that is how we set our tone up on the key terminologies and definitions that we need to understand when we talk about IAS 16, property, plant, and equipment. All right, let's begin the journey. This is where it gets really interesting, the recognition criteria. How can an entity recognize revenue? Sorry, did I say revenue? Or when can an entity recognize a transaction as a property, plant, and equipment in accordance with IAS 16? When can the entity do that? One, that the entity controls the asset because of past events. Keyword, we control the asset. Now, remember last week we established what control means. We said that control means we are directing the usage of the asset, and that number two, significantly, future economic benefit or service potential in the assets flows to the entity. So we will recognize a transaction as an asset in our books if and only if we control the asset due to past events. But not only that, we're going to also say that it is probable that future economic benefit associated with the asset will flow to the entity. Future economic benefits associated with the assets will flow to the entity. Will flow to the entity, meaning we're going to be receiving the inflows, the revenues from the usage of the assets. Then, number three, the fair value or cost can be measured reliably. So, do we control it? Yes. Will the or do we direct the usage? Yes. Will the future economic benefit flows to us? Yes. Can we measure the cost reliably? Yes. If we answer these questions, then we can recognize the transaction in that case. So that is the recognition criteria for property, plant, and equipment. But after we talk about the recognition criteria, two broad things are going to be coming on our mind, which then sets the tone for us. The first thing is going to be the issue about initial measurement. Initial measurement. And then subsequent measurement. Initial measurement and subsequent measurement. At the initial recognition or measurement of property, plant, and equipment, two accounting standards are likely to be introduced. Even it could be more than that, but we're going to, for the purpose of our discussion, IAS 37, it's going to be a measure, it's likely to be a measure and the initial recognition, that is provisions, contingent liability contingent assets, to IAS 23, borrowing cost, is going to be another standard that is going to be part of the initial recognition. The number three, IAS 19, employee benefit. Employee benefits. At the initial recognition of of PPEs, these three standards may be incorporated. In other words, when you have a question that relates to initial recognition, the question may have elements of IAS 37, elements of IAS 23, or elements of IAS 19. And so that is very crucial. So this is where the relationship that exists between the standards and how the standards must be learned connectively, or that the standards are interrelated, comes in. I hope you are getting the idea. So you don't say, oh, I finished learning IAS 16. No. How about its connection with IAS 23? How about its connection with IAS 37? How about its connection with IAS 19? You must know that very well. On subsequent measurement, we're going to be borrowing a principle from IAS 36, that is the impairment of assets. So on subsequent measurement, one standard that we're going to be introducing ourselves with is impairment of assets, IAS 36. So you realize that directly, this is coming up. Then on subsequent measurement also, another standard that we can have connection with is income tax. IAS 12, income tax. To be specific, talking about deferred tax. Because on subsequent measurements, the way the asset is going to be carried in the books of the entity may be different from the way it is carried in the books of the revenue authority. For that reason, that will result into deferred tax asset or deferred tax liability, which must be accounted for in accordance with IAS 12, income tax. So at the initial measurement or initial recognition, three standards are likely to be connected in the scenario. On the subsequent measurements also, we're going to have IAS 12, we're going to have IAS 36 coming up in that regard. Like I said, this is where the journey begins. This is where the journey becomes really interesting. So you want to stay with me very well here. Let's start with the initial measurement. Let's start with the initial measurement. Initial measurement. Let's start from there because that is where it starts. That's where it starts. I mean, how do we determine the initial cost of a property, plant, and equipment? What should constitute the initial cost of property, plant, and equipment? That is a question we want to ask here. So before we know, it's an asset. So the journal entry here is debit PPE, okay, credit, whatever, cash, credit bank, or credit whatever, payables, or whatever the heck that we need to credit. Sometimes we may have to even credit equity because if we are settling the debts through shares, we may have to credit equity. So this is the journal entry. That's a journal entry. We don't need a miracle for that. That's a journal entry. We need to debit PPE and credit cash, credit bank, credit payable, or credit equity, depending on whatever is going on. But the question we ask ourselves is, what would be the amount? Because you see, measurement means the determination of the amount at which a transaction or an item is carried in the books of the company. So if we say we should debit PPE, it's a good thing. How much do we debit PPE with? If we say we should credit something, how much are we going to credit with? So that is where initial measurement comes in. Are you getting it? Now stay with me carefully here because a lot is going to go down here. In accordance with IAS 16, property, plant, and equipment, the initial cost of an asset shall include the following. The initial cost of an asset shall include the following. One, the purchases price of the asset, including any import duties we paid, any non-refundable purchases taxes, after trade discount. If it happens that we got a trade discount from the purchases of the assets, why not? That becomes a deduction for us. But if we bought the assets outside of our jurisdiction, then import duties will apply. That should be included. If we paid some non-refundable purchase tax, that should be included in the initial cost. So primarily, that is the initial cost of an asset. That's the initial cost of an asset. Now, note that sometimes the asset would have to be constructed by the company. So purchases cost may not be the subject or the topic for discussion here. Instead, it will be the manufacturing cost. So if it happens that the asset was manufactured rather than how do we call it, purchased, then the manufacturing costs would have to be part of the initial cost. Does that make sense? Would have to be part of the initial cost. But that is the starting point. That's where we start. But even though we start there, we don't end there. It doesn't end there. So there are other directly attributable costs that can be included. Directly attributable costs. What are these directly attributable costs? Number one is cost of employee benefits. That is where I spoke to you about IAS 19, employee benefits. Cost of site preparation for installation, initial delivery and handling cost, installation and assembling cost, cost of testing the asset. Because you remember, if it is a plant and equipment, when we install it, we need to test it to see if it is working in the manner that it is expected to work. So those costs we incur in testing it would have to be included. Sometimes when we are buying an asset, we need to pay professionals because we need to engage some consultants to check our power capacity, to check the capacity that we require, to check the some legal documents, because sometimes some assets, when you are buying it, you have to sign a contract for continuous maintenance, and so those documents relating to the terms and condition would have to be read by a professional, a lawyer or something like that, and we need to pay that person. So that those costs that we incurred in arranging to purchase the asset becomes part of the initial cost that has to be recognized. Then initial cost of dismantling, because certain assets required that at the end of their useful life we remove them, and that is where IAS 37 is going to be coming into the picture, and I'm going to show you that in a moment. And then borrowing cost, if we borrowed money to manufacture the assets, to construct the assets, to acquire the assets, then the borrowing cost relating to the assets, I'm going to explain that to you also in a moment so you understand, must be recognized. All right. So these are directly attributable cost. These are directly attributable costs. So in putting that into perspective, we see this diagram coming up here. We see this diagram coming up here. Give me a moment. Let me shrink my page a little bit. Forgive me. I'm on it. No software, and I'm getting myself familiar with it a little bit. So this is the format. So the purchases cost will come in. We've said that already. Import duties come, delivery costs come, installation costs come, pre-production testing comes in, legal and other professional fees will come in that particular case. Then dismantling costs. Oh, this is where IAS 37 will be coming to town. I'm seeing some questions relating to this. Let me see if I can take them real quick. Then we can continue. Let's see. What do I have? DJ King said, hi. Hello, DJ. Said, how are you doing? I'm flourishing, and I hope you're doing well too. Emmanuel said, Nhyira, please add transfer pricing and discounted cash flow to your topic list. Okay. Transfer pricing and discounted cash flow. I hope transfer pricing in management accounting, because there is transfer pricing in tax as well. Joshua said, my interest is practice management and rules of group audits. Okay. Group audits. Okay. Joyce said, hello, Nhyira. Joyce watching from Uganda. Thanks a lot for the good work you do. God bless you. God bless you too, Joyce. Thanks very much. Bontil said, finally tonight I managed to join you guys. I have been watching your videos. That's awesome. Thanks for joining us. Ruth said, wonderful lesson. Thank you. Watching from Lusaka, Zambia. Thank you. Lansana said, Kalana from Sierra Leone. Thanks for joining us. Baswa said, thanks very much for your efforts to assist us. Always a pleasure. Alan said, just repeat on the difference between fair value and selling price, and most which one supersedes the other. I'm saying that the fair price, the fair value is the price at which an asset is exchanged or a liability settled between market participants in an arm's length transaction. Okay, that is the fair value. But I'm saying that sometimes, even though the fair value is how much the asset should be exchanged for, sometimes that is not the actual price at which it will be exchanged for. It will be exchanged for at a price above or at a price below. And that is because of related party transactions. So there are certain times where the selling price may be different from the fair value. The selling price may be different from the fair value because of related party transactions. Ochri Bonsu said, good evening, boss. Good evening, Ochri. Alan said, sir, when you say liability, if the car we use is not ours, but someone hired it to us, we recognize it as liability in our balance sheet. Where have you non-current liability as? If you hire a car, how can you recognize it in your books? If you hire a car and you have not paid for it, yeah, that's not a non-current liability. I don't know the context of your question though, but because he said if the car we use is not ours, but someone hired it to us, we recognize it as liability in our balance sheet. No, IFRS 16 leases. I don't know the context in which your statement is coming from, but in accordance with IFRS 16 leases, there are two alternatives. If you are renting the cars, you are saying it could be a low value asset or a short term hiring. In that case, it will be treated as a normal rental. You just debit the P&L accounts and credit cash book, or you credit current liabilities if you have not paid the money yet. But then if you choose to go with a default approach for leasing, then that is where you need to recognize the leased asset in the books. So you debit right of use assets, and then you credit how do we call it? Lease obligation. And that is the initial recognition. Then on subsequent measurement, you have to depreciate the lease asset, and then you amortize. You carry the lease obligation at the amortized cost. So I don't know the context in which you are coming in, but that is the principle about IFRS 16 leases. Do we subsequently depreciate it? Yeah, that is what I just answered. I don't know if that makes sense for you. That's what I just answered. That it depends on the alternative you are choosing. You can watch our video on the YouTube channel on IFRS 16. We explain all the principles relating to IFRS 16, and probably that can inform your understanding well. But like I said, there are two ways the treatment can be done from IFRS 16 perspective. Either it should be treated as a short-term lease or a low-value asset. In that case, we treat the transaction as a normal rental, But then if the entity choose to treat it in accordance with the default treatment, then we debit right of use assets and then credit lease obligation. That is initial recognition. Then on subsequent measurement, we depreciate the right of use of assets on a straight line basis, using either the economic useful life of the asset, if ownership will transfer at the end of the life of the asset, or we use the lease term if ownership is not going to be transferring. Then the lease obligation is going to be carried at amortized cost, where we recognize the lease current liability, non-current liability in that regard. Edith Gwenze said, Amanda Chikura. Okay, I think she's notifying somebody to join the stream. Ugoji Eberi. Forgive me if I don't mention your name right, okay? I'm gonna try to mention well. So Ugoji Eberi, I think so. I think that should be Nigerian, I guess. Hello, boss. Do you have a video on fair value treatment? Fair value treatment on what? If you're talking about IFRS 13, which is fair value measurement, there is no video on that here, but there is a video on that in our full course on our online portal. If you enroll in our full course, we have videos on all the standards. So we don't. If you're talking about IFRS 13 fair value treatment, I don't think we have a video on that on YouTube, but our full course should have IFRS or has an IFRS 13 for the principles relating to IFRS 13 fair value. So if that's what you are asking, you may have to check out our full courses. Okay, let me bring back my screen and let's jump over. Okay, I'm good. Right. Okay, that was me being asked. Okay. So what are we saying here? We are saying that at the initial recognition, as part of the purchases cost, as part of the delivery cost, as part of the installation, pre-production, legal and other professional fees, dismantling cost, restoration cost, environmental cost, that's present value would have to come in. So this is where we are then introduced to IAS 37, provisions, contingent liability, contingent assets. So let me explain that to you for you to see how that is going to be contextualizing on the initial recognition situation. Now, when it comes to IAS 37, two things we have to take away here: provisions and then liability. You know that liability is simply a present what? Obligation as a result of what? Past event. Present obligation as a result of past events. That is what we mean by liability. It's a present obligation as a result of past events. Then provision is simply a liability of uncertain amount and timing. A liability of uncertain amount and timing. Meaning you owe someone, but you don't know exactly how much you're gonna. You know you owe someone, but you don't know how much you owe the person, or you don't even know um how much when you're gonna pay that money. Okay, so it becomes a provision, not Gary and Sugar and Milo. Provision. Okay, a liability of uncertain amount and timing. So, for instance, let's say that we have a court case pending. Okay, and as per the court case, we know we have to settle something because probably we breached the law, and so we have been taken to court. Maybe our driver crossed the traffic light, and we have been processed to court, so we are in court. We know we're going to pay some money, but we don't know because judgment had not been given yet. So we know we owe, but we don't know when we're gonna owe or we're gonna pay that money as well because of the judgment that hasn't come yet. So under IAS 37, these are the two things we must understand: provisions and liabilities. But the question we ask ourselves is, what is the recognition criteria for provision? What is the recognition criteria for provision? In other words, at what point can provisions, this dismantling cost, this restoration cost, this environmental cost, at what point can we have a figure coming there? So, what is the recognition criteria? We say that when it is, or if it is rotten, you provide for it. Rot. If it is rotten, you provide for it. What the heck is that? It means that R means reliably estimation of the amount. So reliably estimation of the provision. So we need to be able to estimate the provision reliably. O means that there has to be a present obligation. T means that, transfer, the settlement will result into transfer of the economic benefits of the entity. Settlement will result in transfer of the economic benefits of the entity. So can we reliably measure it? Do we have present obligation? But the starting point of all these is present obligation. Please stay with me carefully here as we explain this. So when we say present obligation, what exactly do we mean? So present obligation. Now, there could be what we call a legal obligation or a constructive obligation. A legal obligation or a constructive obligation. Now, legal obligation comes in as a result of we signing a contract, okay? As we sign a contract, or maybe that obligation arises due to a license that was issued to us. And so we have to satisfy the terms of the contract in that particular case, or better still, because of an act of parliament that guides our operations as an entity. So let me explain. Let's say we are an oil company, or let's do mining. In this part of the world, some of the mining companies, I don't know, but we move. Let's say we are a mining company. Okay. When companies mine, what happens is that they destroy the habitat of various, uh, you know, organisms. So the land is destroyed, water bodies are going to be affected, the entire ecological system or the ecosystem, it's partly going to be affected. Now, if as part of the license agreement that the mining company received, they are required to um, landscape the place, grow grasses back, um, make sure that everything is working well after they finish mining, probably 20 years, then that becomes what? A present obligation. For that reason, if they are determining the initial cost of the oil rig, sorry, or the mining site, the equipment that they are using and all that, they would have to what? Include that cost of landscaping, that cost of restoring the land to how it was. That is what we mean by legal obligation. If it is part of the contract that is signed, if there are laws that governs mining, states that you have to do that, or if it is part of the requirement for the license that was issued to you, then there is what? A legal obligation. But sometimes an entity may not be liable because of legal obligation, but sometimes what we call constructive obligations. Constructive obligation arises due to the expectation that uh, a company has created by the entity. So, for instance, the entity has a policy that, oh, if you buy if a device from us, we have 12 plus 1 month warranty. Oh, that's nice. So warranty. I mean, that is Techno, I guess. 24 months warranty. That is Samsung, I guess. So immediately, anytime we sell goods, customers know that, hey, if the product becomes faulty in terms of software and those things, I'm going to get replacement or free repairs at no cost within the warranty what period. That is called constructive obligation. So you don't owe the person because you've signed a contract. You don't owe the person because any law on an act of parliament is saying it. You owe the person because of the expectation that you've created by your policies. Or sometimes a constructive obligation can also come in due to a green policy on the company's website, on the website of the company. So usually the company will say on their website, "Oh, we are an environmentally responsible company." Da 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 da. All of those things. So it means that even if they go to a country where, for some reason, the country did not require them based on law, based on acts, based on license requirements to restore the land to how it was, to landscape and to make the place beautiful, because of the fact that this company has a green policy on its website that mandates it, that even though there is no contract requirement, even though there is no license terms and condition, even though there is no act of parliament that requires them to do that, because of the green policy on their website, it becomes a constructive what obligation. So they have to then bring that up generally in their books. Or better still, the last one that we can talk about, so expectation that we've created, green policy on our website, or maybe the past behavior, the general past behavior of the entity can also create that constructive obligation. So, for instance, just an example, okay? So, let's say that they went to whatever, maybe they went to Vietnam, uh, and they carried an activity in Vietnam and they did restoration. They went to China, they carried an activity on in China, they did restoration. They went to another a country maybe in Europe and they did restoration. What the heck? If you come to Africa, You got to do that because everywhere you go, you do it. So even if you come and for some reason our leaders don't give you those terms and conditions, there are no laws governing that, oh, restore the habitat, be responsible on the environment, because of the past behavior, because of the things that it has been done in other jurisdictions, the entity will still be what? Liable. So that is what we mean by present obligation. That is the starting point. So to decide whether we're going to include dismantling cost, restoration cost, or environmental costs as part of the initial cost of an asset, we have to first ask ourselves, is there a present obligation? So when you read the question, you have to be able to deduce the clue that, okay, it's possible that this company has to make some payments in the future, but do they have obligation to make that payment in the first place? If they have an obligation to make that payment in the first place, then what is going to be happening is that it's going to be included in the initial cost of the assets. The reason why you must understand this is that when it comes to provisions generally, they can be divided into two. When it comes to provisions generally, they can be divided into two. Generally, provisions can be divided into two. We have asset-related provisions and then non-asset related provision. Asset-related provisions and then non-asset related provision. When we say asset-related provisions, it means that on initial recognition, because the provision is in connection with an asset, what happens is that initial recognition, we're going to debit property, plant, and equipment with that provision that we have calculated, and then we'll credit what? Provisions. That is initial recognition. But then if it is a non-asset related provision, meaning the provision has nothing to do with any asset, doesn't have any connection with an asset, then what is going to be happening is that that provision will be written off directly in the profit or loss account. So we will debit profit or loss and then credit what? Provision. Again, that is about initial recognition. So for instance, there is a court case, okay, of an employee who has taken us to court for whatever, unfair dismissal, okay, and so we are likely to pay some money. That is a non-asset related provision. So that provision has to be recognized where? In the P&L account. Are you getting it? Or maybe there is, again, there may be a court case with us, and there is somebody who is suing us for something. Again, that is what? A non-asset related provision. Or we've given warranties. That is a non-asset provision. Warranties has to be written off in the profit or loss account in that particular case. Or there is onerous contract or onerous contract. This is a one-time contract we are undertaking that results into a loss. Such provisions must be recognized in the P&L account. But if it is something relating to dismantling the assets, okay, something relating to restoring the assets, something related to environmental cost or environmental provision, these are assets related. So them or these must be recognized as part of the initial cost of the asset. So when we talk about provisions, we have asset related provisions. They must be included in the initial cost of the asset. It is for this reason why we have the dismantling, restoration, and environmental cost here. And also we have non-asset related provisions, and these ones are not in connection to with any assets. So what's going to be happening is that we recognize them in the profit or loss accounts. Does that make sense, please? Any questions? Any questions? But then finally, then I bring you home to where we are at. Finally, then I bring you home where we are at. Is to talk about reliable estimation. So how do we estimate the initial provision? Now, there are various methods that can be used to estimate provisions. Let me talk about present value, since it is something that is going to be crucial here. So present value, as you know already, it refers to discounting future cash flows into present terms. Discounting future cash flows into present terms using the cost of capital of the entity. So this is where those issues about environmental cost and all those things will come in. So let's say that for instance, an entity is liable to pay. So as part of the contract, an entity is required to restore the environment after its mining activity in 20 years at a cost of $400 million. Okay. Cost of capital is 13%. So let's say this is the scenario we have. In the discussion. So as part of a contract, an entity is required to restore the environment after its mining activity in 20 years at a cost of 400 million. So what do? They are supposed to, it's a contract. Is there a present obligation? Yes. Because of the contract. How much are they supposed to pay? $400 million. When? In 20 years. So what we do is that we bring that $400 million into present terms. So we have to discount it. So the present value is going to be the future value times 1 over the discount factor. Now, there are ways that you can calculate your discount factor. You know that already. That can be 1 over 1 plus R exponent N. So my discount factor will be 1.0, 13%. So 1.13 exponent 20. That's how we calculate the discount factor. Where's my calculator? So let me punch that out. 1 over 1.13 exponent 20. Ooh, I'm getting something like 0.087, something like that. So that the present value of the environmental cost is going to be the $400 million times 0.087. And that gives us an amount of I'm getting 34.8 million. So we've brought that value into, so it means 200 million, or it means 34.8 million today is 400 million in 20 years time if the interest rate is what? 13%. If the interest rate is 13%. So what is the journal entry? Simple. This is where we debit profit or loss. Did I say profit or loss? Sorry. We debit PPE because it's an asset related provision. And then you credit provision. That's the initial recognition. This is what we are saying. It will be included in the initial cost of the asset. And that is how we are getting this figure here. That's how we are getting this figure here relating to the initial cost of the asset. That's how we are getting this. That's how we are getting this. So is there a present obligation? Hell yes. Why? Because of the contract that we signed, right? How much are we paying? $400 million. When are we paying it? In 20 years. So what do? We discount that into present terms. And this is just the initial recognition of provisions. This is the initial recognition of provisions. Any questions, please? Any questions? Any questions? I'm seeing some charts coming in. Let's see if I can take them real quick. Let's see. Raymond said, "Sir, please, do you have videos on published accounts Nigeria?" I don't know what you mean by Nigeria, because the financial statements, financial accounting, it's based on the IAS requirements, and there is just a slight change. I don't know. We have financial statement videos on the channel, so you can cross-check that if it is relevant to you. Iberi said, "How can I access the full courses?" You can visit our website, NhyiraPremium.com. The link is in the description of this video, the first link, or you can download the Nhyira Premium mobile application on the Google Play Store or the App Store, and you'll be able to get access to that. Hi, sir. Hope you are well. Is it possible to raise a provision for the estimated cost of future major inspection? Major inspection? Do you incur cost when regulatory authorities come to inspect us? Do we incur cost? No, it doesn't. Do we have the question you have to ask yourself is, do we have a present obligation? No. No, we don't have present obligation. Even future major repair costs, it doesn't still qualify us unless otherwise there is a regulatory requirement. So let me give an exception. Unless otherwise there is a regulatory requirement that every 2 years or every 6 months we are required to, maintain the asset, like in the case of the aircraft or the airline industry. Are you getting it? Then in that case, we are under obligation to undertake the maintenance and do the repairs because the law requires it. So that one we can provide for it. But if we don't have any present obligation, there is nothing tiring us, and it is just a company policy or whatever the heck, we cannot provide for it. Does that make sense? That is Nandi. Does that make sense? So major repairs, major inspection, I don't think there is a present obligation for that. If they are coming to inspect us, we're not going to incur any cost. I don't know. But that is my take on that. Mamosam said, "Good evening, sir, and the class. This is a financial reporting, corporate reporting class." Alan said, "How can I get these notes for today?" Which notes? I'm coming in from my book. Discussions are coming in from my book on financial reporting. So that is the material that I'm using for the discussion. Daniel Kumi said, "Is there any help for SEMA FPL students?" I don't think we have contents in that regard for, SEMA specific on the channel here to assist that. So Daniel, unfortunately, I don't think. You can check, maybe there could be some reference contents on the channel, but specifically, we don't have any content on the channel relating to that. Okay, so that's it about that. Fortunately, because of time constraints, I'm going to be concluding around here, and we're going to see possibly tomorrow. We're going to continue with our discussion, or Wednesday. You can follow me on Instagram, because the discussion for the meeting will be posted on Instagram, and if it relates to something you're doing, then you can join me on the live stream. We have our public sector class in a few minutes, and I need to get myself prepared for that in that case. So I'll be concluding around here today. Nandi said, "Makes total sense. Thank you." Okay. Amanda Chikura said, hello, sir, but if it's a company policy, is it not legally binding? No, 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 no. A company policy is not legal binding. A company policy is not legal binding. So if you have a policy of maintaining your assets, that does not meet any criteria. The word is, do we have a present obligation? Like, do we have a present obligation? So sometimes, usually 99.9% of the time, it's not legal binding. It's not legal binding. I mean, your policy is your policy. That is why, for instance, insurance. A company can say they are insuring or paying for insurance. Then they are like, oh, they've paid for insurance over the years, nothing has happened. It's like they are throwing the money away. So instead, they will put that insurance money aside and put it into an investment, so that should something happen, they will use that money to finance it. Now, can the entity provide for such? It is called self-insurance. Can the entity make provision for self-insurance? The answer is no. But that is the company's policy. The answer is no. You can't make provision for self-insurance. But if you are paying the insurance, it becomes an expenses. So that will be written off in the P&L. But if you are making an investment, so that should that something happen, you finance it from that investment, that's part of investment. You cannot provide for it because it does not meet the recognition criteria. So a company policy, it's all you get. A company policy may not meet the criteria for recognition. Then Malebo said, when are we meeting for FR? We just finished an FR class in that regard. So that is it about that. I'm going to conclude around here today. I believe that you are getting the understanding when it comes to the standards. And most importantly, knowing how the standards are interconnected and interrelated. And on our next session, what is going to happen is that we will look at a second connection that relates to the initial recognition, and that is borrowing cost, and how we determine the amount of the borrowing cost that should be included in the initial cost of the asset. Because, like I said, when it comes to initial recognition of property, plant, and equipment, three standards are going to be part of that collection, and that is IAS 37, provisions, contingent liabilities, contingent assets, IAS 23, borrowing cost, and IAS 19, employee benefits. So it is very important for you to know how these things are supposed to be recognized and incorporated in the initial recognition. And that is how you learn the standards. That's how you learn the standards. So if you know that that is how it is, initial recognition, that's how you go about it. Subsequent recognition, that's how you go about it. That's how you increase your chances of passing the examination, and most importantly, also understanding the standards in general. So that's it about that. Thank you very much for joining us on the live stream today. We have what we got: Malebo, Amanda, Franklin, Ahia Deku, Wilson, giving us thumbs up and hearts on the video on Facebook. Really appreciate it. Remember to follow me on Instagram at Nhyira Premium, because our meeting details are going to be posted there as well. Then you can also subscribe to the channel here on YouTube and subscribe to my channel on Telegram. That way we will send the links out and you'll be able to get a message directly on your phone. If you subscribe to my channel on Telegram, we send it out and you'll be able to get a notification and then join the live stream, so that I can assist you to be able to prepare well for the examination and pass the examination. Remember, download our mobile application Nhyira Premium, because you get some exclusive content there on video, on post, to enable you to prepare well for the examination and pass the examination. So that's it for today. Thank you very much, and I'll catch you some other time. Stay safe and take care. Bye-bye.